Good afternoon, and thank you for tuning in to today's webcast, the DoubleLine Diversified Fixed Income webcast titled As the Cycle Turns, hosted by Deputy CIO Jeffrey Sherman. Again, the title of today's webcast is As the Cycle Turns, which is in some spooky font apropos of a October webcast, and it's in relation to the Fed's cycle going from a hiking cycle to a rate cutting cycle. I'll turn over to Mr. Sherman in just a minute, but first, a few housekeeping items. On the screen now, we have some content announcements. A lot of this content can be found on DoubleLine's YouTube channel. We have the Channel 11, which is a monthly series hosted by portfolio manager Ken Shinoda, and a recent episode of Perspectives with Ryan Kimmel talking about the U.S. debt spiral. You can register for upcoming webcasts and receive a copy of the slides from today's webcast by clicking the Request Webcast Content in the player. Now moving on to some other DoubleLine Media Thought Leadership. Again, we have DoubleLine's Channel 11, The Sherman Show Podcast, The Minutes Podcast, and Perspectives. So today, Mr. Sherman is going to be discussing DoubleLine's macroeconomic views and provide an update on our fixed income asset allocation funds. Those funds can be seen on the screen right now, and those funds are the DoubleLine Low Duration Bond Fund, the DoubleLine Flexible Income Fund, the DoubleLine Core Fixed Income Fund, and the DoubleLine Opportunistic ETF. A quick overview of performance and yields before turning it over to Mr. Sherman. So looking at performance of the DoubleLine Low Duration Bond Fund year-to-date through September 30th, the fund, looking at the institutional share class, has outperformed its benchmark, the ICE BofA 1 to 3 year U.S. Treasury Index, by 82 basis points, with a 30-day SEC yield of 5.19%. The DoubleLine Flexible Income Fund, the institutional share class, is ahead of its benchmark, the Bloomberg U.S. Aggregate Bond Index, by 288 basis points year-to-date, with an SEC yield of 6.74%. The DoubleLine Core Fixed Income Fund, the institutional share class year-to-date is ahead of its benchmark by 128 basis points, with an SEC yield of roughly 5%. And lastly, the DoubleLine Opportunistic Bond ETF, ticker symbol Delta Bravo November Delta, is ahead of its benchmark by 143 basis points year-to-date, with an SEC yield of 4.69%. So with that, it is my pleasure to bring on our Deputy CIO, Jeffrey Sherman. Mr. Sherman, take it away.
Mr. Joya, thank you for the kind words and the introduction there. So thanks for also front-running the meaning of my title, so I didn't have to explain it. But when you asked me about it earlier, I was thinking it was kind of more along the lines of the soap opera, As the World Turns. So we put a globe out there. It's always easy to say the cycle turning, as you'd mentioned. You know, we're talking about kind of the rate and the interest rate regime cycle changing potentially, but that doesn't mean the cycle is coming to an end. And so what I'd like to do is go, as usual, go over the macroeconomic landscape, just talk about where we are kind of in this overall cycle. And then from there, kind of talk about the position of the funds, what it means for the funds, and how we're thinking about it as we go through the rest of the year. And I'd like to remind everyone that, you know, looking at the kind of post-World War II era on trendline growth is that, you know, we did a very good job for many years of having a 3+% growth rate. The challenge is that, you know, post-GFC, you know, once we had the global financial crisis, we really never got back on that trajectory. And you can see here the slope of that dotted line went from the blue dotted line to the red dotted line. But good news is that we're above trend since the GFC, and that includes recuperating from the pandemic experience. You know, when you start to use this rounding, you see that we're about 0.2 trillion ahead of the long-term trend. I remind everyone that that means we're 200 billion above that trend. So that is actually a positive thing. And if you look at what the IMF is scheduled or forecasting going forward, it's essentially along that that red dotted line as well. So the positives about all of this is that, you know, we continue to kind of perform similarly to that post-GFC era. And it's good to see that the economy continues on that trajectory. So to me, what this means, there's just a change in potential for the output for the U.S. economy. And I keep using this chart, and every time I say I don't want to go back as far, and every time I still go back to the 2010 experience. And what I like about this chart just shows kind of the range of estimates and where we actually ended up in terms of GDP growth. And again, this is on a real basis. So it's the annual numbers that we see in that post-GFC world. But really, notice the numbers on the right-hand side of the chart. They're essentially two handles across the board. The good news is that during 2023, we're forecasted again. In 2024. Apologies there. The forecast there is getting us back to 2.6%, which is above last year's estimate of 2.5. Remember, the estimates will converge to the actual numbers, and is actually, if you look at this, one of the better years of overall growth since the global financial crisis. Obviously, 21 was the rebound from the pandemic, especially after the amount of money we printed out there and injected in the economy. I'll talk about that a bit later. But notice the 2010 experience, that's coming out of the GFC. The 2018, a lot of that was off the tax cuts that got passed in the 2017 experience. And so if you think about where we are overall from an operational standpoint or output, the economy's done very well post-pandemic era. And so again, I just kind of show this chart just to show that there's a lot of range of estimates. You can see here the evolution of 24, with the most forecasted recession in the history of mankind that happened throughout 23 and 24. Now we've kind of moderated. Even in 25, economists are saying, you know what, maybe indeed this is kind of middle of the cycle and that we're not scheduled to fall off a cliff. So all the times we were talking about falling off a cliff, at least from the consensus estimate, it did not seem to transpire. And there is some reason for optimism. And again, this is not actually looking at the output of data. This is an economic surprise. And so what was pretty amazing about during the most forecasted recession ever back in 23 was that the data kept surprising to the upside. And so again, the surprise indices, all they really show you is that where the data is coming through relative to expectations. What you see here too is that all of a sudden, in 24, we were underperforming the expectations. So it's because those expectations rose, but all of a sudden the data has started to tick up, at least again, relative to expectations. And if you look at this versus the rest of the world, it's doing quite well. And so once again, the US is the place to be. And so part of that is because of something I alluded to, was the amount of injection of liquidity that we put into the marketplace and the overall economy starting in 2020. And obviously, some of this was an aberration due to the pandemic. We got addicted to those policies. We did it again in 21. In fact, the creation or the expansion of the monetary base over those 2 years was north of $7 trillion. And you can see that actually we did have some fiscal restraint. It may not feel like it, but actually there was a contraction in the money supply during the 2022 experience. But the bad news is that we don't continue to do that. We're expanding that monetary base once again. But if you look here, just like we're looking at the trend line growth in the global economy, or sorry, the U.S. economy, what you can see here is that this is still a meaningful amount above what would be that kind of long-term trend of increasing the monetary base. And so, one, some of it is why we had levels of inflation. But secondly, this money found a home. This money didn't just evaporate. We didn't go out and light this money on fire. We put it into transactions. We did things. We traveled. We spent it on services. We speculated on assets. Look at financial assets. It's sitting in those markets. It's sitting in the housing market today. So I won't say that you can always print your way to wealth, and that's usually not a good way of borrowing your way either. But this money does exist today, and it does sit in the system. And so potentially this is something that's helped kind of keep the economy going over these periods of time. Well, where did it come from? Well, it came from the government. And so the good news is that the government is running one of the lowest deficits we've seen since the pandemic. But the bad news is it's still a pretty scary number. In fact, if you compare today's deficit, as a percentage of overall aggregate growth or GDP, what you would see is that this is what used to look like peak recession periods. So obviously the last couple of cycles have changed, or at least post-GFC, where we tend to have a meaningful change in the deficit. And something really changed in the last, let's call it, I don't know, maybe 8 years or so, where we tend to be running these larger and larger deficits, even during what are called the good times. And so there are excesses. The excesses sit within the public sector. The money has been printed. It has existed out there, and so potentially that's part of what's kind of still sitting in the overall economy. But the bad news is with the hiking cycle is that we've seen interest rate rise, and with the interest rates rising. What's happened is that means as we've recycled some of this debt, remember we finance a lot of our debt short term. And so by doing so, that means the average coupon has actually went up. This chart used to say average interest rate continues to rise. But if you got your magnifying glass, you can see all of a sudden now with interest rates coming down a bit, and I'm not talking about the Fed's cutting, but just essentially when you look at kind of where market rates are, what that's done is that's actually led to newer issuance, helping bring that aggregate kind of effective rate down, albeit very slightly. And so I won't get too giddy about this, that the interest rates are going down here. We've seen some blips downward before that didn't lead to long-term deceleration. But potentially as this cycle turns, as the Fed is cutting interest rates and trying to normalize, or I should say recalibrate policy, to use the Fed chairman's word that he used at the press conference extensively, what you see here is that maybe this kind of gets you back to where this debt burden won't continue to rise meaningfully. The problem is that if you take the CBO's estimates, if you look at the amount of interest that is being spent in the budget relative to the revenues, it continues to accelerate. Again, this is still from the 2023 experience, and these expectations are set to go meaningfully higher. And so we'll have to see as policy evolves next year. Obviously, we have an election in less than a month's time, or exactly 4 weeks' time at this point. That, again, may change the path here. But I think most people would prognosticate, irrespective of who's in the White House or who's running Congress, that we're likely to continue to spend. So this remains the elephant in the room. It will continue to be the elephant in the room. You'll hear people in a lot of circles talking about this. But for the time being, it's not that relevant of a conversation because the impacts aren't today's problem. They are the future's problems. Obviously, future problems can become today's problems, but markets are definitely not focused on this. And the bond market will tell you when it's time to focus on that. So let's get into the nitty gritty of the economy right now. There's a very large disconnect between the two time series I'm showing here on the screen right now. And this is the difference between two pockets of our economy. This is the service sector as well as the manufacturing sector. And these are surveys. The surveys are essentially asking people, are you planning on expanding your business, or are you kind of curtailing your business? You can think of it as a contractionary, expansionary signal for each of these segments of the market. And so it's a diffusion index. So when the response rate is 47.2, that means 47% of the folks who respond are more negative than positive. And conversely, the 54.9 means 54.9 are positive versus being negative. And so you can see here that there still is this service-based economy that tends to have this expansionary feel to it. And the good news about this is that, one, it is what drives the bulk of our economy. Roughly 80+% come from the services part of the overall economy, where manufacturing makes up less than 20% of the overall economy. But in general, part of the thing is that services have also been where we're seeing inflation as well. And so from the standpoint is that there's the good with the bad here. We're seeing this expansion in services. We've seen it in the employment in the service side, but also you're seeing it somewhat in those prices paid as well. And by the way, I have a chart on that. If you go to the next slide here, what you see is that manufacturing is now saying that they're paying less than what they were paying before for their input costs, whereas services are going the other direction. And so you're getting two different signals from two different parts of the economy. The one that's the larger part of the economy, the services, is saying things are more expensive. It's also saying hiring is being there. Remember, a lot of services have input. One of the largest input costs is labor. But also you're seeing the opposite, where The manufacturing side is saying, well, the prices paid for inputs are not as great as they used to be. So this doesn't mean that prices are going to be coming down across the board, but it does give you some sense of the disconnect where if you look at pure manufacturing data, which a lot of these traditional leading economic indicators are focused heavily into manufacturing, they tend to give you a completely different signal than what you're getting kind of the aggregates, and a lot of that comes from the service part of the economy. And so I alluded to the inflationary environment, how services drive that. And so if you take a look at the latest CPI report, and so each one of these, the black line is the headline CPI number. So it includes goods, services, plus commodity prices. And so, I'm sorry, this does not include commodity prices. This is core CPI. I apologize for that. But if you notice here, what you see here is there's that dark blue area, which is the goods component out there. Now, when I show this chart to a lot of people when we're in client meetings, they'll say, this is just false. I mean, there's no way goods are not getting cheaper. And I will agree with you in some way. It doesn't feel like they're getting cheaper. The prices at least stay the same. But there's also these adjustments because the quality of goods is supposedly higher. It's what the economists call hedonics for those adjustments. But if you look at the services components, notice here that core inflation, if you just look at services, is 3.7% today. And so you can see here that that lighter blue area tends to be the bulk of what's driving that. That is the shelter component. By the way, notice how that rate has ticked up recently. Remember, everybody's talking about the lagged effects of the shelter market, how it's going to be on this path down, but it has ticked up in the last print. And there's been a little bit more pressure on the rent side of the equation. Some of that's true from the roll rates that go through rents, but also just some of the lack of multifamily that hasn't been coming to market due to higher rates has put a little pressure there. But notice that beige area. If you look at the contribution, and this is taking the weight of these sectors times its inflationary component, and that's what stacks the bar there. That beige area doesn't seem to be declining, right? It's been pretty steady that you see overall, and that contribution to overall CPI has been running in that kind of mid 1.4%. And so if you look at this chart, what you see in the 21 and 22 era, this was the supply chain story. That was what was driving inflation along with the housing market. Yes, there was some services ex shelter that were driving it. Those have not dissipated, by the way. Shelter has come down a little bit, but this is why the Fed is having the challenge with this last mile of inflation concept, is that goods are helping to track and bring inflation down, but the key parts that are more sticky, in fact, there are series out there that talk about the sticky components of inflation, and I didn't include in the presentation today because you wouldn't be surprised, but the sticky components of inflation are indeed sticky, they're higher, and the ones that are not are actually dissipating or not really contributing meaningfully to the overall CPI. And so in general, this causes a challenge for the Fed too, because they definitely want inflation rate to get closer to 2%, but you're not getting exactly the trends underway. We know the Fed cut this last Fed meeting when they met roughly 3 weeks ago. But what you see here is that inflation is coming down. It is much more contained. It's much better than that core inflation rate of 6.5% we were experiencing, almost 2 years ago. But one thing you don't hear from in the Fed anymore is this concept of supercore. And supercore was the idea of taking the core services, taking out the housing component. I used to always joke that, well, if you take out commodities, because no one needs food, no one needs energy, let's take out housing because that's not really relevant in most people's lives either. So you live on the streets, you don't consume any commodities, then you have super core inflation. Well, take a look at this. Well, the reason you don't hear about this concept from the Fed anymore is that these numbers aren't supportive to the overall argument. And so I'm going to retire this slide after this presentation day. We won't talk about it again. But the thing is that inflation is still a problem. It's just not as meaningfully problematic as it was. And more importantly, I think what you're seeing is that it's that stickiness of prices or the lack of the Fed allowing there to be deflation in the system that prevents prices from coming down. And so I think the Fed feels comfortable about their inflation objectives. It's moving in the right direction. So on their dual mandate, the key is to focus on the employment component. And that's what the market has been doing for a while. inflation's somewhat under control. We'll get another print on Thursday of this week to see where the CPI report shakes out for the month of September. But it should be August date, I guess. But if you take a look at the labor market, it continues to give you kind of strong data. Now, we know there's been some revisions to the data set, so maybe the numbers are a little lower than we see on the screen here. But you see, irrespective of the time series that you're using, we'll use a household survey of the non-farm payrolls. Both are surveys, by the way. If you take a look at that, well, what you see is that the household survey really hasn't created a lot of jobs over that period. Remember, the household survey just asks if you're employed, so it doesn't pick up multiple job holders, versus the non-farm, which has had a lot of adjustments. There's been a lot of criticisms about the birth-death models as well, and then that's what's driving a lot of the jobs. But I think we can all agree that the jobs number that came out last Friday and the report spooked the bond market. This idea that everything was well contained, that the labor market was rolling over, the Fed needs to react very quickly. That was really doused by that last report. What to see again? Even Goolsbee that comes out and loves when the farm payrolls are very strong. Said one data point doesn't dictate policy. I agree with that. Let's see if the strength will continue. But there's also been a lot of this kind of idea that the jobs are all part-time jobs versus full-time jobs. And what I show in this chart over the last couple of years is that there was a lot of full-time employment growth during the 2021 experience. We got a fair amount in early 23 as well, but it's really been mixed, whether it's full-time or part-time. Notice these bars, they kind of bounce back and forth. And so when you look into aggregate of the economy, we've been adding jobs. Now, the part-time side always gets, it gets a lot of flack. And I like how in the household survey, there is the concept of saying, well, if you're part-time, why? Are you part-time for economic reasons or for non-economic reasons? And so what's always disconcerting is when you see a big spike or an uptrend in the economic reasons, right? That's saying that, you need to be working, you're not able to. Non-economic reason encompasses everything else. And so what you see here is that maybe there's a shift in tastes and preferences. I'm not here to say that we should have a bunch of part-time workers in our economy, but this is a trend that's been underway for the last 60 years. And so when you take a look at that, yes, there was a revision to the estimates. That's why you see that spike in at the end of 93. But you can see here that there has been this increase in part-time employment across the economy. And so nitpicking it when it's convenient for one's own narrative is not really a good way to think about the economic landscape. But it is pretty important to see that there seems to be people working. There seems to be, again, not a lot of people getting unemployment insurance. Take a look at this slide here. There's two time series here, one with an average. The left-hand axis is the continuing unemployment claims. So what happens is that when someone loses their job, again, this is not a quit, but you lose your job, right? You were terminated or your job was let go. When you file for your unemployment insurance at the state level, you get initial claim. So you're the initial claim. From then on, from the next week, the next set of initial claims are people who are new to that unemployed force. And so the continuing claims are the people that are just sitting out there looking for work, getting this unemployment insurance, but not able to procure a job. And notice how eerily stable that line has been for the last 12 months. Yeah, there was a little bit of an uptrend over the spring to summer months here in those continuing claims. They seem to kind of stabilize in this 1.8 to 1.85 million number. And if you look at the continuing claims, and it's noisier because, I'm sorry, I said continuing. If you look at the initial claims, it's a blue line. That axis is on the right-hand side. You can see there's roughly 225,000 that are coming out of the labor force each month. But if you look at that 1.83 million of continuing, well, that says in about 6 to 7 weeks, you'll get, or at least 7 weeks, you kind of replace that part of the labor force. And so this doesn't seem to be this big conundrum of that people aren't being able to find jobs once they are on this form of unemployment insurance. I like this data, one, because it's not a survey, it's actual data. There are challenges with this, like any government collection agency here. But in general, to me, this kind of signals that there is some stability, or at least this continuity once one loses a job, the ability to find one, let's say, within a couple of months' time. And another way of thinking about this is that, as I showed with the part-time employment force, the labor force has grown over time. And so if you think about this in the context of, let's look at those continuing claims, where they are, and let's compare them to the size of the labor force, you start to get a different picture here. And notice here too, that this is one of the lowest levels we've seen absent where we were like in that kind of peak employment post-pandemic era. But notice where we were at this level going into the pandemic as well. So looking at the continuing claims as a percentage of the overall labor force is not giving you this radically, dire picture on the labor market in the U.S. And so there seems to be some stability and some continuity out there. This isn't bode well for the folks that are not working today, but in general, this is something that just trying to think about ways of framing the data that again, maybe paint a different picture than what's getting all the headlines out there today as well. And, this is a favorite chart of the Fed. I was joking with the analysts that put this together. It's like, man, could you make the scale any more distorted to make this look like a negative picture? Because what you find is that there's 8 million jobs available according to the JOLT survey, but there's only 6.8 million people that are looking for work. Man, that sure doesn't look like a 1.2 million person gap in that chart, because it's so distorted by the experience that we had post-pandemic. But look, the job openings rate continues to go down. The hiring rate is going down. The quits rates is going down. So that means there's just much more stability out there. But again, the openings rate, and I saw the SOM piece about being commensurate with, kind of a higher unemployment rate about 10 years ago, has seen the openings and hires rates out there. But these numbers look in the context of at least the last 20 years, they seem to be pretty solid numbers. And so again, I'm not seeing as many cracks in the labor market as people try to look for in the data today. That said, we know labor's fickle. We know it's a lagged indicator. It's one of the last kind of shoes to drop in the economy. I like to always say that companies don't lay people off because they think a recession's coming. They think they're either mired in one, their business is suffering because of that recession, or they have a bad business as well. And they need to essentially kind of restructure that business. So in general, this is something that's still positive. It can obviously turn very quickly in a cycle. It can be hit by exogenous shocks. But for all the criticism out there about the data, it sure seems to be that the labor market is really holding up. Why this is important: if people have jobs, they typically get paid. When you get paid, that means you earn money. When you earn money, you tend to spend some of that money. And that's what drives our economy, my friends. Another thing that we keep hearing a lot about is how bad the non-farm payrolls data is. And again, it's a government source, so is the JOLTS data. So one of the analysts on the team put together something to look at the hires minus the separation. So this is how many people you employ, less how many people leave. Either you let them go or they leave the firm on their own volition. And compare that to non-farm payrolls. And if you take a look here at this chart, and we're not trying to lie with axes here, but if you notice here, the time series seem to be very highly correlated, one. And secondly, they're not giving you much different of a signal. Now, granted, they're both government data sources, but there's been some made about this. So we zoom in over the last few years, and you can see at these time series, they have been a little noisier. The hires versus separations has had a little bit bigger moves in magnitude versus non-farm, but in general, they're roughly in the ballpark of one another. And I think if I told you the economy was creating 200,000 jobs a month or 240,000 jobs a month, you'd say same difference at this point. And so what you're seeing is that both data series are kind of giving you a picture that says maybe there is some truth to these numbers. Yes, in some instances, the birth-death model is likely over-exaggerating the amount of payrolls out there, but also just in terms of the aggregate number of workers in the economy, it sure looks somewhat reasonable today. Another thing that kind of ticked up was wage growth. We saw that tick up on average hourly earnings in the last report. That's the blue line here. Notice here for a 394 kind of wage growth. I thought I saw it round to 4.0. So I'll have to question that data source there on the round there. Maybe it's like 3.946, and that rings to 395, which rounds to 4. But anyway, point being is that these are still healthy numbers, right? This is still a wage growth rate that is meaningfully above what we were seeing pre-pandemic, at the pre-pandemic levels. Then you find supervisory employees that are ultimately in the Atlanta Fed. It's not really supervisory, but what it is you actually measure the same person. You ask them what they made last year and what they currently make. And you see that wage growth is a little bit higher as well. And so irrespective of how one slices this today, it sure seems like labor is still doing quite well. And someone's asking me already a question there, is asking about the longshoreman settlement and what it may mean for inflation. Well, it means higher wages. You're damned if you do, damned if you don't there. Either you pay the workers and you have that pass through of inflation on that side. You don't pay the workers, we have supply shortages, and all of a sudden we have higher prices too. So it was one of those things where, again, this is the negotiations with labor. Very convenient. They did it about a month or so prior to the election. I thought they would drag it on a little bit farther than they did. But again, it's not over yet either, right? That agreement only goes through, I believe it's to the beginning of January. But so if things are so rosy, why do people feel so bad? Why is the sentiment so bad? And I used this in the previous webcast, and I think this encompasses how people are feeling. Because if you take, and I've rightfully, or I very methodically picked the start date here, and I didn't do it to cherry pick the data. I just know that the average hour earnings, if you go to the previous slide, notice that big spike we got during the pandemic. It's not that people got a lot of wage increases during the pandemic, right? That's not what happened early in the pandemic. It's that the labor force changed, right? It was the lower end worker that was laid off. Thus, if you look at the average hourly earnings, it went up, right? Because it's a change in composition of the labor force. So what I did is I said, let's just start in July. Let's index it and let's see what cumulative inflation looks like over this period versus cumulative wage growth. And what you see here is that, unfortunately, using average hourly earnings, inflation using headline CPI has outstripped the cumulative progress that people have made on their wages. Now, this is again the aggregate data, and it's using this average hourly number. We did it with the Atlanta Fed number, and they come in neck and neck on each other. They're roughly the same level, or the cumulative inflation is roughly in line with what the wage growth is. But what you see here is that the slope of the lines have changed, where the wage growth has been somewhat constant over this period. You see that the inflation, with it coming down a bit, people are starting to make up the gap a little bit. But this is why people feel so horrible. At least that's my contention. People remember traumatic events. And if you ask someone what the price of something is, they're going to compare it to December of 19, or they're going to compare to some period prior to the pandemic. And so because we've had this surge in inflation, it's what's kind of, I think, weighing on the psyche of folks that feel like they haven't made any progress, or they're doing significantly worse than they were. And so, again, obviously, asset owners have done extremely well during this period, right? We talked about financial markets since the pandemic. We talked about the housing market. If you're an asset owner, you have done quite well over this period. It's the labor that has struggled. And for as much strides we talked about the labor market, when you put it in this context, it sure doesn't look like they've done a lot. But if you look at the savings rate, it has went up a little bit. This was due to some of the revisions of the data where GDI went up, so the incomes went up. Thus, it changed the disposable savings rate a bit, or disposable income and thus savings rate, because this is kind of the plug out there. But you can see here that these are not really abnormal levels, especially if this is a true savings rate and it was sitting in cash, right? The bad news is cash is going to yield a lot less going forward than it has over the last 12 months. In fact, 12-month cash rate has been north of roughly 5.5%. And obviously with Fed cutting rates, that's going down meaningfully. And so from the standpoint of that savings rate, for this idea that everything's consumption is that people just drew down on savings, it doesn't seem to be corroborated by the data set. But the bad news is the consumer is showing signs of stress. And these are aggregate delinquency rates. So these say that you're more than 3 months late on a payment, whether it's a credit card, auto loan, student loans, a peer-to-peer loan, whatever that may be. Notice there that the mortgage rate delinquencies continue to tick up a little bit. Student loans have been dissipating meaningfully because of some of the relief efforts there, and also just what we've noticed there, even in those that are still due today, the delinquencies are quite low. Maybe they're better quality borrowers that are out there. But what you do find is these tend to be driven by the lower income strata and the bottom FICO cohort. So recessions always kind of start and manifest from the bottom. Crises do manifest there too. Doesn't mean they're spillover effects, but you are seeing that these are relatively problematic here. And so again, that these aren't all translating into defaults, but there's a reason you see charge-off rates being a little bit higher, more reserves being held for losses out there. And so again, this is not a great trend out there. But what's strange, if you juxtapose this against the kind of thinking about the disposable income or the net worth of some of folks out there, what you notice is that people's wealth has went up in aggregate. And so again, this is the asset owner. This is obviously biased by the kind of upper echelons of income and financial prowess. But look at where this chart is relative to the last 30 years or so. And so there still are income levels. Again, asset prices have done quite well. And so some of this may be leading to why the economy has done okay, even though it was the most telegraphed recession in the history of my career. Moving on to small businesses, this is the pain point. It has been for a long period of time. The optimism just really can't get out of its own way. This part of the economy has once been heavily impacted by interest rates. Small businesses, they don't have access to capital markets. They can't go to the corporate bond market and do a debt offering. They got to go to the bank. And so what that means is that short-term interest rates have an impact. And so not surprisingly, seeing what's happened with short-term interest rates, what you find is that these folks are still paying in the high single digits to borrow money. Maybe this is part of the reason that the Fed wanted to cut rates. Maybe this is why the bond market has been encouraging the Fed to cut rates all year, because this is one of the big pain points of the economy. And if you got these animal spirits going, where you reduce borrowing costs, potentially you could see some CapEx, you could see some activity, you could see some expansionary behavior within the overall kind of small business cohort. So I guess when I roll the whole picture together, I still see labor being somewhat intact. I see the economy still firing. I see the consumption still on the service side. And so it makes me question whether or not we're at the very later end stages of the cycle. Yes, things can still turn. You can still get to where things could fall apart. If we decide to all save money and we don't want to consume anymore, that can be self-fulfilling in its own right. But right now, it sure feels like as we end 2024, that the U.S. economy is still in a decent spot today. So what does that mean for markets? So I like to start with volatility of markets. I look at volatility of markets as a way of signaling, is there stress? So the black line is the one that most people look at. It's equity volatility, or it's AKA the VIX index. Well, when you look at that, it's not really signaling meaningful stress in the market. Yes, it was 22 last Friday. 22 is the close yesterday. Some of that has to do with the rate vol and how things moved around a little bit. Notice that blue line is back to some of the highest levels we've seen all year. That's rate vol. That's what happens when the curve sells off 13 to 24 basis points across the curve. You're going to get some rate volatility over that period. But notice that these indicators don't really seem to be signaling meaningful stress. Yes, rate vol is higher than it used to be when the Fed was out there kind of with its zero interest rate policy, with inflation well contained, rates weren't volatile. But if we rolled this chart back, 25 years, you would see from the cycle from the post, from the tech crash, let's say in the recession we had in 22 and 23, that recovery until the GFC, you really didn't get this is kind of normalized rate volatility. That's what happens when you're not manipulating interest rates, doing QE, and all these things. And so in general, something to watch again. But the bond market was very negative. The bond market has been extremely pessimistic about the path of interest rates, that they're going to go down. The Fed has to cut hundreds of basis points over the next 6 to 12 months. That's what's been priced in the market at different points throughout this year. And I want to remind everyone that 2.5 weeks ago, the bond market, before we got this jobs report, post Fed meeting, was saying that there would be 200 basis points of interest rate cuts from the overnight rate for Fed funds rate by June of next year. And from our standpoint, sitting here looking at that, that has to be a dire situation that gets us those levels. Something has to miss economically. So although prices recalibrated on Friday, we saw a reprice of the bond market. One, it's nicer to see, right? We now have four-handle yields at parts of the Treasury curve once again. But secondly, it just got rid of some of that pessimism that was in the marketplace. So I think rates look a lot fairer today. But again, there's going to be some noise as we have to deal with the labor market as well as the inflation data, and we're not through the woods yet. Performance in the third quarter is very strong. It's been really nice in the two client reviews I've done thus far. It's nice to talk about how good the performance has been across bond markets. What's pretty interesting here is that it's been a fixed rate market in the third quarter. Since the Fed kind of indicated their next path was to cut rates, that they were going to do so, they needed to wait a little bit longer in the data. Fixed rate markets have been moving ahead of the other parts of the curve, and you see this in the third quarter performance. The laggards here still made pretty good money for the bond market. Worst performer at 170 basis points for a quarter. By the way, that annualizes north of 6. I think we'd all take that. And what you see here, it's that fixed rate stuff that did much better. And so in some instances, you have a year's return that was baked into the quarter. In fact, let's look at the year. Year to date, you can see that treasuries, again, were negative going into the third quarter as we saw that rate back up. Remember, rates were kind of low going into the beginning of the year. They rallied in January and spent most of the year selling off. So we had a negative to the first half of the year. But notice what's really done well are the things that have been more speculative assets. The non-agency CMBS market, this was really beaten up last year. The triple Bs are kind of that fulcrum tranche or where some losses will erode into. And so there's been there was pessimism there. So there's been some optimism went throughout the year. The triple C leveraged loan market, right? You look at the high yield market, if we went to triple Cs, those would be some of the best performers as well. Look at EMD, emerging market debt, kind of showcasing how long that's, how well that's been. A lot of that is longer duration than the US market as well. So in general, what you find here is a bond market that's done quite well this year. And you look at credit, this year, you've been rewarded for junkiness. The worst the quality or the things that did very poorly last year are the ones that have done quite well this year, or the things that did really bad in 22 and took 2 years to recover. But notice the highest quality bonds on the far right-hand side are the least performers. I won't call them worse since they're up almost 3% or so, but obviously owning credit has been a good thing to portfolios. Owning credit's been good, owning rates has been good. Now the question becomes, what do you do at these levels today? And I like to remind people that even though we've had a pretty meaningful rate rally, rates are still elevated from the experience we had in that post-GFC pre-pandemic era. And no matter where you look across the curve, rates are higher than they were at those periods of time. And so, as I mentioned, seeing four handles on rates again looks pretty interesting out there. Again, from a short-term tactical perspective, we've thought about, should we be buying duration or not in the portfolios? We had a meeting about today. We like our positioning right now. I'll talk where that sits in our funds as well. I'm going to skip the inflation break-evens. Bond market doesn't care. We got a little pessimistic there in terms of pricing it. We're back to kind of where we were. I do want to take a second on the dollar, though, because in meetings, I've had a lot of people point out to me that the dollar's declined until that we saw in the last couple of trading days. But the dollar decline, this must be the deficit, the stuff that we're all talking about, how much of the deficit is out there. But it's really just interest rates. And this shows you from this chart. We can use the 10-year. We use the 10-year here. It lines up quite nicely here. You can see in the last couple of years. But as rates have come down, as policy expectations of rate cuts has got accelerated, what that's done, especially as the rest of the world, we're going to converge down lower. What that would to the rest of the world, that kind of equilibrates some of that dollar behavior. And so you can see again with our spike in rates, given what happened last Friday, all of a sudden the dollar pops back up again. So in general, it seems to be a one-way trade. I don't really have a strong view on the dollar today. I think you got to get the interest rate call right at that point, and that's what we'll focus more on than trying to think about the dollar. If you buy a generic index fund, you're back to 450 in yield. If you look at kind of the ETFs out there, they're lower yield because, again, they bought the bonds at higher prices. I'm sorry, they were higher priced than they are today in a lot of instances, and thus they don't have the same current yield on them. But if you look and assume par payback, about a 4.5 yield. 4.5 yield doesn't sound horrible to me when thinking about investing over the next couple of years. Looking across various parts of the market, I like to take these next couple slides together, or these next two slides together, where we look at yields. This is the range of yields over the last 10 years. So the minimum max for each of these segments of the market. Notice where we trade today relative to the average of the last 10 years, still relatively elevated. So I hear this a lot from our credit teams, yield buyer, yield buyer, yield buyer. And I say, great, it's you're a yield buyer. People are trying to lock in yields, but also spreads do indeed matter. And so from that standpoint, if I can buy a 10-year treasury at 4%, should I think that 4.9 is great because it's above average on corporate bonds, or does it look rich? And so one way to think about that is to now look at where the spreads rank. And this chart does it slightly differently because we're doing a lot on the same chart. What you show on the vertical axis is the percentile ranking. So higher the number, the cheaper the asset is over the greater the spread you get relative to the last 10 years, or at least on a percentage ranking basis. And then the horizontal axis simply shows you what that spread is. Notice what jumps out here. First of all, IG corporates are at one of the lowest percentile rankings they've been in 10 years. So as I show you in our portfolios, there's a reason we are very underweight those assets. Notice high yield corporates as well now have a very similar outlook. In fact, that spread is inside of 300 basis points, about 285 or so today after today's trading. Look at emerging market corporates. Once again, one of the tightest spreads we've seen in the last 10 years. So when you open up the DoubleLine funds and you look at our positioning, even though I'm not worried about these asset classes, especially in the U.S. market, I think IG corporates should behave somewhat like treasuries over the short term, just given the deleveraging, the debt service coverage ratios are extremely high, the low coupon on the service of the debt. Same with high yield corporates. If the economy is still doing, if it's going to continue to fire like it has in the last 3 to 6 months, I think corporate spreads, albeit tight, make some level of sense. But when you have the menu of choices and you can find things that offer an above median spread, and again, can get you a meaningful spread out there, it's something you have to take a look at. Now, the bank loan spread's a little distorted because of the triple C market. If you strip out triple Cs, the yield spread's probably more like 350, 375 or so if you pull that cohort out. So it's not as cheap as you see here, but we're using broad indices as well. But notice things like high quality mortgages, whether they're residential, they're commercial rated, either of those still offer pretty significant yield spreads out there relative to history, even the asset-backed market. So I want you to keep this in mind as we transition to the portfolios, because this will kind of glean a little bit of insights into the portfolios. So let me start the low duration fund. The low duration fund of the 4 funds I'll cover today is going to be the lowest of the volatility spectrum that we're running this. This is thought of as a cash plus proxy out there in today's market. Sure doesn't feel like it with the 4.8 yield to maturity, but guess what, my friends? That's kind of what the direction that bills are going at this point. If you buy out the curve about a year, you have yield pickup in this type of portfolio relative to kind of those trash, those I called it trash. I was going to try and say cash and treasury rates out there over the next 1 year, the 12-month bill. And especially if the Fed is forecast, it delivers, let's just say, on the dot plots, which the Fed chairman kind of alluded to at the last press conference, then you definitely have the ability to pick up some of this and lock it in. As you see right here, we have a duration of about 1.6 years. We did extend the duration of this portfolio early in September. We did so simply because we thought that, again, looking along the curve, we wanted to own a little bit more risk. what if the Fed delivers on these cuts that the market's thinking about? And what that did was ultimately we lengthened the duration out a little bit on this portfolio for that reason. But if you look at the credit risk across the portfolio, very high quality. You can see almost 70% of the portfolio is AAA rated. When you look at the below investment grade, excluding the non-rated securities, it's about 5% of the portfolio. The unrated, probably half of those are roughly investment grade or high quality investment grade rated. And so from that standpoint, it's a very high quality portfolio. And you can see that if you look at the historical volatility here. But notice the credit we own. There's not a lot of investment grade corporates. There are no high yield bonds in this portfolio. We do own some loans. We do like bank loans because we thought the market was too aggressive on the Fed cuts. So we did like owning some floating rate debt on that side of the portfolio. But notice we still have almost 30% in government-backed assets, especially when you add cash back in there. So this is meant to be a stable portfolio. The idea here is that we want to buy securities we think can survive throughout a full cycle. And we're constantly kind of rotating this around. Notice what's also happened over the last quarter or so, non-agency CMBS have become the largest piece of the credit portfolio. One is we find that some of the front end of the curve in that position has been much more attractive than CLOs, especially in the AAA floater segment of the market. And so from that standpoint, this is one of the areas where we are making our largest credit bet in there, but again, it's very, very high quality. If you want to kind of see the behavior of this type of portfolio in the CMBS market, take a look at our other ETF out there, DCRE, that actually is fully dedicated to securities that look like the risk we own in this portfolio as well. So I do that because people get nervous hearing about CMBS. But Jeff, you told me this is a very short duration fund. It's a high quality, low volatility. How can you have so much there? And I say, well, it's the asset types that one owns. But notice here, significant tilt to the securitized market, equal weight in terms of how much we own in EMD versus investment grade corporates, a very high quality portfolio that we think can thrive in many different environments. By the way, this yield is about 20 basis points higher today than it was at the end of the month, right? And that's simply just given the rate movements we've seen. Moving on to the riskiest of the four, so I'm barbelling this. I'm going to start with the low duration, low volatility. This is a lower duration credit portfolio, what we call flexible income. So you'll see bookending that had a yield at the end of the month about 610 basis points, almost about 190 over the index. As I said, you can kind of move rates up probably 30 basis points, since month and quarter end. But notice here, even in this portfolio, that's more of a credit tilt. We have a higher exposure to government securities and some of the highest levels that we've had for a long period of time. We have taken some of this down lately, and some of that happened at the beginning of the month as we were just talking about credit markets where some of these markets had lagged, like in CLOs, like in the securitized world, even in some bank loans that we like the shape of that forward curve, especially before the repricing we saw last Friday. And so we actually took some of our treasuries down and started buying a little bit more credit in this portfolio. And that's not because we're trying to get significantly riskier. The idea was that we thought there's some good technicals in here. There's support from the underlying economy. And thus, it made sense for us to kind of move this out, not be as conservative, especially with cash rates coming down. So just like investors are rethinking their portfolios, what do I do if the Fed's going to cut rates? What's happening? We did some of that in this portfolio as well. So we've been hiding in some of these treasuries, these very short-term treasuries for a while. But to us, it was time to rotate. We didn't really move the duration around this portfolio over the course of the quarter, nor since that point in time. We've been just essentially moving a little bit of that portfolio around. That said, notice here, the below investment grade bucket's about 25% or so of the portfolio. We still have an elevated level of cash in the portfolio. That some of that trading I was talking about that we're trying to raise money for. But also, again, this portfolio through most parts of the cycle should be like 35 to 45% below investment grade. It's because of the shape of the curve, the credit curves, I should say, that you're not getting paid meaningful to pick it up. So this has to be very calculated risk that one wants to take there when you go into below investment grade. But right now, again, with the 200 basis points roughly pick up to the ag, we think it's an attractive place to be, especially if the economy continues to produce in the fourth quarter. The last two portfolios are going to be in that intermediate kind of segment of the market, things that are supposed to look more like the ag. So this is DBLFX, our core fixed income fund. And the next one will be the ETF version, the DoubleLine Opportunistic Bond ETF, or DBND. And you'll find that between these two portfolios, very similarly positioned. We did take our duration down in the portfolios in the third quarter. First week of September, we decided to kind of bet against the market a little bit in those rate cuts. We've been somewhat vindicated on that kind of idea over the last month or so, because we just thought that the market was way too aggressive in some of those rate cuts, and just again the shape of that forward curve. But again, quality-wise, highest quality that really since probably in the last 10 years that we've had. The below investment grade sleeves being about 15% of the portfolio, very low levels across the portfolio. Some of those triple Cs are in legacy assets of the non-agency market that we've owned for 10 plus years at this stage. So it's definitely not as low quality as it looks on that side of the equation. But also notice here, we have a tilt towards credit. The government-backed sleeve is about 42%. We have a little bit of cash. Some of this was trading around at quarter end. But also, look, we have a bias towards credit. So as much as we've been negative and warning about things, the markets haven't been giving us the signal that we need to wholesale credit. We're getting compensated for the risk we're taking in the credit markets today. And again, because of the attractiveness of some of these securitized markets, things that just haven't been as popular as like IG, let's say, high yield corporates that everybody focuses on, it's given us the ability to want to own a little bit more credit at this part of the cycle. So again, the yields are a bit higher, call it 30 higher since the end of the quarter. I was thinking 20 originally, just thinking the last couple of days, but rates have went up since the Fed cut rates. Very, very counterintuitive to most. And then lastly, DBND, before I start into questions, you can see here, very similar layout when I look at the upper right-hand side of the chart. We have a bias towards credit, a little less cash in this portfolio. But again, really no significant policy differences here. The below investor grade is a little bit different composition. Some of it has to do with not buying a lot of those legacy assets that sit in the portfolio in the mutual fund that have been there for a long period of time that we still love today. So all in all, what I think the message, if I had to convey this very shortly, I know I've talked for, like 55 minutes now. What I would convey here is that, there still is value in fixed income. There's value in having a blend together. Definitely having a blended credit portfolio to us is much better than having just one single sector bet. We still own some floaters in the portfolio in case the Fed isn't as aggressive as the market thinks. We own some duration to keep us comfortable with those overall kind of blend of the credit we own. And we're not going out there and being very aggressive. We have 100 plus basis points pickup, or roughly 100 basis point pickup. When I look at, kind of the intermediate part of the curve, you got 200 if you want to take that credit risk portfolio. On the front of the curve, we think we're delivering, kind of a full cycle, above like the 2-year, you have about 100 there. So in general, that's where we think you should be playing today. There's no screamingly cheap opportunity where one sector of the market is saying you need to be super heavy in this part of the curve or this sector of the market. But in general, we think a balanced portfolio, as it's treated you well all year, is still the place to be in the fixed income market. So with that, I'm going to finish my prepared remarks and move on to questions. Someone said, when are real interest rates going to begin to decline? They actually have. If you've been paying attention in the last couple of months, call it 3 months, nominal rates are down. And by the way, the inflation rate has been somewhat stable to slightly down. And the nominal rate's been dropping faster than the inflation rate. And so they have started to decline. By the way, I don't root for meaningful declines in real interest rates. If we get paid positive real interest rates, that is a good thing. That means we're protecting purchasing power. Our income is greater than the inflation rate, and thus you're making advances relative to the inflation. So be careful of rooting real interest rates to decline, unless you're trying to be an equity investor and telling me, well, that means the multiple can expand, and those things tend to be somewhat correlated, not pari passu or just in lockstep. But in general, I like getting paid for taking bond risk that's above the inflation rate, especially when I can do so in a calculated manner that we just talked about. Someone's asking about 10s and 30s over the rest of the year. and the first quarter. Like I think that we're somewhat range bound. Call it 4 on 10s, plus or minus 25. So we're dead in the middle of the range roughly today. We had a strategy discussion today. Maybe we should buy back duration at some point, but today's not the day. We're proud of what we've been able to do in the third quarter, and we'll take that in stride. Long bond, I think the long bond should trade a premium to the 10s. There seems to have more risk. There's about a 25 or so premium in the market. Maybe it gaps a little bit. So add another 5 to 10 to that, and call that the range as well. 10-year returns are not enough to cover inflation. If you buy a 10-year treasury, they are. If you buy a 10-year CMBS bond, they are. I'm pretty sure that most markets are enough to cover inflation today. So maybe you're looking at trailing 10-year returns, but then you have to look at the trailing 10-year inflation as well. And so bond returns have actually been on a real return basis have been positive over the last 10 years. So curious to see why you're saying that. So shoot us a message, info@doubleline.com. Next question, given how badly voters feel about inflation, does it eliminate any policy option to inflate away the debt? I think is what it's trying to say. If so, what's the alternative? Well, look, I think that policymakers are in their own self-interest. I don't think that they're even thinking about inflating the debt. I think what they're trying to do is, help their constituency, right? Get policies that they think are going to help their jurisdiction. So I think people feel bad about inflation. They didn't like to experience it. But if we can get rid of some of the debt burden through inflation, I think that's the way to do it. Another alternative, although not popular, you can default on it. Probably not a good thing for capital markets, especially being the reserve currency. So that's probably not a good alternative. Another option is that the Fed can buy the debt. Remember, all those treasuries that sit on the Fed's balance sheet, all the treasuries, they rebate that back to Treasury every time they get a coupon payment. And thus, that means that they finance those at zero. So there are ways through that. But again, they're not popular. Most people don't understand them. I like to tell the joke in meetings, or at least I think it's a joke. It's not really that funny when you really start to think through it. But I hear about the bond market will teach the Fed, teach our Congress and policymakers a lesson. And I like to ask the question, what do you think the percentage of policymakers out there today know what the long bond is? And so the answer is not zero. But I always ask, is it 20? Is it 25? I know it's not 50. Or I would speculate it's not 50. I don't exactly know it, but so again, remember those who are not don't have in their vested interest to make the best decisions won't either, and so it's something to have to think about. My opinion, gold, it's $25 cheaper than it was yesterday. Sure has been a killer asset. Again, if you think of gold in any currency, including the dollar, it's been a really, really good ride for gold. So I don't really have a long-term opinion about gold. I think it's a good thing to own in your portfolios as a what-if scenario. I don't think you should own 20 or 30%. But having 5% or so in gold probably isn't a bad thing. I hate kind of the chart today, because I said at least it's $25 an ounce cheaper than it was. Someone's duration for optimum return. I kind of addressed that. That's what the next slide. Next question said. Last question. Does the growth of dedicated CLO ETFs in declining rate environment have you concerned about pricing liquidity in the CLO market? What happens if these vehicles experience outflows? Well, I don't have a concern about it because the growth has primarily been in the AAA rated sector. Most CLOs, the AAA rated sector is 70% of a deal. And when you look at one of the largest ones, it's about 10 billion. I think in aggregate, there's probably in the AAA CLO ETF market, call it 12 billion, maybe 13. My ETF guy is going to get upset with me for not knowing that, but call it 12 to 13 billion. We've had 170 billion of issuance this year. So it is a drop in the bucket. It can be absorbed. Maybe if there was a mass liquidation by retail, you would end up with, a repricing of that market a little bit, but institutional community would gobble that stuff up. And so from that standpoint, our CLO book of business across the capital structure that we run at DoubleLine, we run 5 to 6 billion in third-party managed CLOs. We run a couple billion in our own CLOs that we run the CLO. So there's nothing wrong with the CLO market. There's nothing wrong with more investors being in it. I would be concerned if it was in, if there was 15 billion in the mezzanine kind of tranches, like the double Bs, or, a split rated like triple B, double B fund. That would cause me concern because that could have a big repricing. So given the structure, given where it's at, I'm not that concerned. By the way, with the spreads you get, I was in a meeting today, CLO folks told me AAAs were like 130, 135 over. You still have a meaningful cushion over treasuries today, or over T-bills today, that I think as long as things move in lockstep, and again, the premium doesn't dissipate because there's too much demand, I think CLOs are a decent asset class for the very short term. I call it next 3 to 6 months. If you don't believe me, go back and look at the low duration fund. It's the second largest credit position in the fund. So obviously, we have an affinity for these assets. In the low duration fund, they're almost all exclusively AAA as well. So we are definitely fans of the asset class in today's environment. So with that, I'm going to conclude the webcast today. Thanks everyone for listening. 65 minutes between Mr. Joya and myself. So we appreciate all the support of DoubleLine, and I'm off the hook for the rest of the year on Webcast. So I will talk to you early in 2025, and the first time you'll hear from me is at our annual Roundtable Prime, where we have many guests here in Los Angeles. We're going to have also some clients here as well. So look forward to that, and good luck with the rest of the year. Take care all, and thanks.